Exploring the stormy seas of stock market crashes, we focus on the 2008 crisis that sent shockwaves through the global economy. The history of stock market crashes paints a diverse picture of economic fluctuations, each with its unique causes and consequences. From the South Sea bubble in the 1700s to more recent crises, these events serve as stark reminders of the volatility inherent to financial markets. Indeed, according to data from market analytics firm Yardney Research, the benchmark index has undergone 38 declines of at least 10% since the beginning of 1950. This averages to a crash or correction every 1.87 years. The South Sea bubble in 1720 was one of the earliest recorded crashes. A speculative bubble in the shares of the South Sea Company in Britain led to an economic crisis when it burst, causing severe economic dislocation and bankruptcy among investors and the aristocracy. In the 20th century, the Wall Street crash of 1929 marked the beginning of the Great Depression, a devastating economic downturn that lasted a decade. Black Tuesday, as it's famously known, was characterized by a drastic sell-off of stocks following speculative investments that led to unsustainable market prices. The Black Monday crash of 1987 was another significant event, which saw the largest one-day percentage drop in the S&P 500 and Dow Jones Industrial Average. On Oct. 1987, the S&P 500 fell by 20.5%, and the Dow fell by 22.6%. This crash was amplified by automated trading systems that led to a vicious cycle of selling. However, none have left a more indelible mark on the world's collective memory than the financial crisis of 2007-2008. This crash not only affected the stock market, but also had a significant impact on the global economy. It is considered the worst financial crisis since the Great Depression of the 1930s. The 2007-2008 crash was rooted in the U.S. housing market. Aggressive lending to subprime borrowers who had low creditworthiness led to an unsustainable rise in house prices. Financial institutions, in turn, bundled these risky mortgages into mortgage-backed securities, MBS, and collateralized debt obligations, CDOs, selling them off to investors worldwide. When interest rates began to rise in the mid-2000s, many homeowners defaulted on their mortgage payments. The resulting crash in house prices caused massive losses for these securities. Institutions heavily invested in these products, such as Lehman Brothers, faced insolvency, and the entire financial system began to unravel. The crisis quickly spread beyond the housing market, causing significant declines in the stock market. The Dow Jones Industrial Average fell by 777.68 points in intraday trading on September 29, 2008, marking the largest point drop in history, until the stock market crash of March 2020 at the start of the COVID-19 pandemic. Before we move forward, we would like to thank our sponsor, the Business, Humanities, Science and Ethics University, BHSEU, USA, for their support. BHSEU is a prestigious American university that offers a 100% online MBA program, providing students with a flexible and accessible pathway to a recognized degree. Stay tuned as we will provide more details about BHSEU and their online MBA program at the end of this video. Government and regulatory bodies worldwide stepped in to mitigate the fallout. In the U.S., Congress passed the Emergency Economic Stabilization Act in October 2008, which established the $700 billion Troubled Asset Relief Program, TARP, to purchase distressed assets and inject capital into banks. The financial crisis also led to significant changes in financial regulation. In the U.S., the Dodd-Frank Wall Street Reform and Consumer Protection Act was passed in 2010 to prevent a recurrence of 2008. The act aimed to increase transparency, reduce risk, and protect consumers through numerous provisions. The 2007-2008 financial crisis had long-term global economic impacts. It triggered a deep global recession, with economies worldwide contracting as they grappled with the fallout. Unemployment rose dramatically, and government debt soared as countries initiated fiscal stimulus measures to revive their economies. In conclusion, the 2007-2008 financial crisis serves as a sobering reminder of how interconnected We would like to extend our gratitude to our valued sponsor, the Business, Humanities, Science and Ethics University, USA, for their support. BHSEU is a renowned American university that offers a prestigious online MBA program. With their commitment to excellence, students have the opportunity to earn a recognized American MBA degree from the comfort of their own homes. At BHSEU, students will benefit from the expertise of highly qualified professors who bring their extensive knowledge to the program. The curriculum encompasses essential business subjects such as finance, marketing, and more, while also featuring specialized courses in emerging fields like artificial intelligence. We invite you to visit BHSEU, University USA website at uchumanities.com for more information about their offerings and to explore the exciting educational opportunities they provide. Once again, we extend our deepest appreciation to BHSEU for their invaluable sponsorship, which allows us to offer exceptional educational experiences to our students. Stay connected with us and receive exclusive content by subscribing now.